Hey, it's Camila Stevenson, and around here we talk wealth. And I want to start by saying this: a financial crisis does not begin with an explosion, it begins with a crack. So I want you to imagine a massive suspension bridge. It's elegant, it's trusted, it's carrying the weight of millions every single day. From the surface, everything looks very solid. The traffic keeps going, the cables look fine, nobody's alarmed. But deep inside the steel, a tiny fracture has formed. Most people don't see it, most people don't want to. And once the crack begins to spread, the entire structure enters what engineers call a doom loop. That means that tension increases, weight shifts, each failing component puts more stress on the ones around it. And then suddenly, the whole bridge is pulling itself apart from the inside. That is our financial system right now. And the crack, meaning the one that determines whether the bridge holds or collapses, is something that most people have never even thought about. It is called collateral. And understanding what happens when collateral fails is the single most important financial concept you can grasp right now, because it is the engine that has driven every major crisis in modern history, and it's running again. Now, I want to say to like and subscribe if you have not already. If you like the video, it does help the video. And if you subscribe, you'll make sure that you do not miss the next video. I also want to say nothing I say is financial advice. Everything I say is for educational and entertainment purposes only. Do your own research and put in the comments if you are starting to see the cracks in our financial system. And if you are, share what it is that you are finding to be a crack. I would love to see how you are analyzing this financial system. I believe a monetary reset is at hand. What do you think? Let me know. Let me explain the collateral doom loop and the crises that prove it. And I want to start with the simplest possible explanation on how this works, because then once you see it, you will never look at a financial crisis the same way again. Now, every loan in the modern financial system requires something backing it. So your house backs your mortgage. Your investment portfolio backs your margin account. Government bonds back institutional borrowing. That backing is called collateral. And the entire global financial system, meaning every bank, every hedge fund, every pension fund, every government, is one giant interconnected web of borrowing backed by collateral. The system works perfectly as long as collateral holds its value. But the moment it does not, the whole web starts pulling itself apart. So here's the sequence. The asset prices drop. The collateral backing loans is now worth less than it was. Lenders demand additional collateral or immediate repayment. Borrowers who cannot meet those demands are forced to sell whatever they can find a buyer for. And that selling pressure drives prices down even further, which makes the remaining collateral worth even less, which triggers another round of demands, which forces more selling. Round and round we go, each rotation worse than the last. That is the loop, and it does not stop until something catastrophic breaks the cycle. What I want to show you is that this loop has fired in exactly the same sequence across every major financial crisis of the last 4 decades. Different countries, different asset classes, different headlines, same mechanisms underneath every single time. Okay, it's the same story. Let's go back. October 1987. Most people remember it as a stock market crash. But what actually happened was the debut of automated financial products that were supposed to protect investors by selling automatically when prices drop. When prices started falling, those products did exactly what they were designed to do. They sold, which pushed prices lower, which triggered more automated selling, which pushed prices lower still. And in a single trading session, the Dow lost more value than it ever had in one day. Not because anything happened differently with the underlying economy. Nothing changed overnight with that, but because A feedback loop of forced selling fed on itself until the damage was done. That was the first time the modern financial system demonstrated that collateral failure is not linear, it's exponential. Each forced sale makes the next one worse. 11 years later, in 1998, a hedge fund called Long Term Capital Management nearly took down the global financial system. Now, these were not reckless gamblers. These were some of the most mathematically sophisticated investors in the world. These were Nobel laureates, former Fed officials, people who built models that had never failed in testing. What destroyed them was not bad judgment. It was the assumption that government bonds, at the time the safest, most liquid collateral in the world, would always hold their value under stress. When Russia defaulted and the Asian currency crisis destabilized global markets at the same time, those bonds stopped behaving the way the models predicted. So the collateral backing their positions lost value. Margin calls hit, forced selling began, and one of the largest hedge funds in history imploded in weeks. The lesson nobody learned was this: when the collateral fails, nothing else matters. Not your models, not your track record, not your Nobel Prize. The loop does not care. 2008 taught the same lesson at scale that was impossible to ignore. The collateral this time was not government bonds, it was mortgages, specifically the securities built by packaging millions of mortgages together and selling them as safe investments to banks, pension funds, and institutions around the world. When the underlying mortgages started defaulting, those securities lost value. The collateral backing trillions of dollars of borrowing simply stopped being worth what everyone assumed it was worth. What happened next was not a gradual adjustment, it was a freeze. The entire market for those securities stopped functioning overnight. Banks that had been lending to each other freely suddenly had no idea what their counterparties' collateral was actually worth. So they stopped lending. Credit froze. Businesses could not make payroll. Money market funds, meaning the accounts people park cash in because they're supposed to be safe as a savings account, well, they broke. Meaning the dollar you put in was no longer guaranteed to be worth a dollar when you took it out. People who thought their money was completely safe found that they could not access it during that time. That is what collateral failure looks like at scale, right? It is a quiet freezing of the mechanisms that make daily financial life function. And then 2012 showed us the version that most people in America never fully absorbed because it happened in Europe. Greece, Italy, Spain. There was sovereign debt, meaning government bonds, and they lost value as those countries struggled under debt burdens that they could not serve. The same collateral doom loop fired again. Banks holding those bonds faced collateral shortfalls. So governments had to rescue banks while at the same time trying to manage their own debt crisis. The institutions that were supposed to stabilize the system needed rescuing from the same system they were supposed to stabilize. And for the first time, we saw something that had not happened in modern Western finance. Depositors, not shareholders, not bondholders, but ordinary people with money in bank accounts had their deposits seized to recapitalize failing banks. And they were not warned about it. They were not given a choice about it. It was seized overnight. The people who lost money were not reckless investors making speculative bets. They were people who thought a bank account was the safest place their money could be. And they were the last ones standing when the structure finally gave way because the institutions and the sophisticated money had already moved. That is the pattern that repeats every single time. The people with access to information and institutional relationships feel the stress building and reposition quietly. The general public feels it last when the options have already been narrowed. Now, central banks have been buying gold for 15 consecutive years, not one or two, 15. The same institutions that manage the systems that have failed in the same way 4 times in 4 decades are moving into the one asset that has survived every version of that failure throughout history. They are not doing this because they think that everything is fine. Okay. So now let me explain why the pattern is running right now and what to do before the bridge snaps. First, let me show you what the current signal actually looks like because this is where most people disconnect. They hear about 1987 and 2008, and they think that was then. This is different circumstances, different era. It can't happen the same way. But the loop does not care about the era. It only cares about one thing, and that's whether collateral holds. And right now, the collateral is showing stress in ways that are not making the front page of any major news outlet, but they are showing up very clearly in the data for anyone that is paying attention. Manufacturing businesses, confidence is below zero, not slowing, it is below zero, which means that the people running the businesses that produce the goods and services the economy runs on have net negative confidence in where things are heading. Consumer sentiment is barely above the lowest level ever recorded. Credit card debt in America just hit a record high, not because people are spending extravagantly. Maybe some people are, but that's not the reason. It's because they are using credit to cover the gap between what things cost and what their income covers. Oil is still elevated. The Strait of Hormuz situation hasn't been completely resolved. I know there's been the ceasefire that the market celebrated for days, and we'll see what happens with that, because that doesn't mean that the market can't go up and down. It's going to be volatile, I believe. We're going to have opportunities up and down. And honestly, volatility makes for great opportunity, as a matter of fact, even if we are looking at the scope of this long term. But Europe has approximately 6 weeks of jet fuel remaining, according to the IEA. Flight cancellations are being warned about. The supply chain consequences of sustained energy disruptions are working their way through fertilizer, food, manufacturing, and transportation at the same time. And the Federal Reserve is frozen currently and cannot cut because inflation is still running, and cannot raise because the economy is already fragile. And so we're sitting still while 39 trillion in debt rolls over at current rates, eating over $1 trillion annually in interest payments alone. Now, put all of that on top of the collateral loop framework we just covered. What happens when confidence collapses in an environment where collateral is already stressed? Well, the loop fires, asset prices can fall, margin calls hit, forced selling begins, and the people who understood what was coming are already on the other side of it before the people realize what is happening. This is not a prediction, this is a pattern, and the pattern has a very specific tale that has appeared before every major version of it in history. Now, let me just say this. I'm looking long term, right? I'm not looking at tomorrow. Okay. So again, when you see stock market or crypto markets go up, down, whatever that looks like, those are just day to day things. I'm looking out. I don't have a time frame for this. I'm just showing a pattern. And here it is that usually when that pattern plays out, silver moves first. And I've discussed this a lot, but I want to keep saying it just so I can let you know and educate you. But it is the most sensitive monetary metal because it is both a monetary asset and an industrial one. It responds to financial system stress the way gold does, but it also responds to economic slowdown the way industrial metals do. So when both of those pressures are building, silver feels them before they are visible anywhere else. Now, silver's up well over 200% in the last year and is sitting at critical points. We'll see where it goes. I love silver, so I have a lot of it in some of my retirement accounts, etc. And I heard it said that silver is the fuse and gold is the anchor. So silver signals the break and then gold restores the balance, right? And so that is something you want to be paying attention to because, as I've stated, gold and silver are outside the current system as protection against the collateral doom loop playing out. And then you have XRP, which you guys know I love. That is inside of the new system being built as infrastructure for what comes after. The bridge is cracking and the insiders are moving. Just look it up. So the signals are very visible for anyone who is trying to look to see where they are and what they are. And so you don't really need to figure out whether this pattern is real. 4 decades of identical crisis has answered that. You should really, I believe, concentrate on whether you are standing on the cracking side or the anchored side when this plays out. Now, remember, the people who came through Cyprus with their wealth intact had one thing that the people who lost it did not. Their assets were outside the system before the system needed it. This is not a complicated lesson, but most people will never act on it until it's too late because the reactive self is still there. It's still making decisions. It waits, it sees, it needs certainty and confirmation. It thinks, oh, it probably won't be that bad. And so it reacts after the fact, after they're proven wrong, right? But the strategic self acts before the moment of maximum stress and not during it. So, personally, what I've done to create my own boundaries and make sure my structure is intact is I hold gold and silver inside a Roth IRA through I Trust Capital alongside my XRP. And that's not a panic move. That is a structural decision made when I was thinking clearly about what the collateral doom loop means for anyone whose wealth is entirely inside the system being stressed. So when the loop fires and asset prices move, the appreciation inside of that account stays completely mine. And there's no forced liquidation to cover a tax bill at the worst possible moment. And then you also have to understand what is about to happen when the Fed chair is switched. Okay. He has a plan. And if you have not checked out the plan, you might want to go check it out because they are going to pump money in this system and assets will be repriced at some point. The fundamental value will catch up to the actual value at some point, even though all markets have been manipulated. But eventually that repricing will take place. And I want to have a structure in place where I do not have to give a dime back of this appreciation. I worked hard, my sacrifice, my discipline to put my assets there, and I want to keep every bit of it. And so that is why I've decided to put those assets inside of that structure. They are also adding in the summertime stocks and ETFs. So that will become an option available. So if you have not gotten started on that, make sure that you go ahead and do that. The link is in the description, and you do have a $100 funding bonus when you do fund the account. And if you have more questions about this concerning how much should you have outside of the system and how much inside of it, and what does that look like for your specific situation, that is something we can talk through in my clarity calls or my coaching community. These are not generic allocation frameworks. These are your numbers, your existing accounts, your plan built around the environment that you are navigating in right now. And so we do discuss that in detail. The links are in the description. I want you to go ahead and drop again a comment and let me know, do you see the cracks and what are the signals? Please add to this community. I do look at the comments and it really do help everyone. Y'all know people go straight to the comments sometimes. And so they want to hear from you and I want to hear from you. Go ahead and like the video, subscribe, and share this with someone who needs to learn exactly what's happening in our economy so that they can position themselves on the right side of this. Because there are going to be those who celebrate on the other side because they were educated and they started to implement ahead of time. And then there's going to be the other ones that are scrambling to catch up, and it's going to probably be too late at that point. And most people will be priced out, especially with all that's happening in our economy, AI replacing jobs. You should really be more intentional and take this time and use it very, very wisely. Manage this moment with prudence in a way that when you get in your future, you can look back and thank your today personality for making those decisions that you needed to make for your future self to be in a good position, meaning financial freedom and your family. And as always, I want you to stay wise, stay wealthy, and I'll see you in the next video.